we're delighted to have you on this webinar today. I will be with Timothée Samqueron presenting, and we're very honored to have two guests, Laurent Seyer and Philippe Marchessaux. Laurent's background has been very active in the industry, being the former CEO of Seyer, and after that the CEO of MSCI. So and with some time spent at AXA Investment Management. Regarding Philippe, Philippe has been really true to BNP Paribas and has been the CEO of the firm for quite some time, knowing asset management very well, active asset management very well, having been a portfolio manager himself. So we're very happy to have the two of them joining. I must say that they both sit on our advisory board, so they've been able to follow the emergence of EquityEdge carefully and quite knowledgeable about the service. Right. Maybe a quick introduction about Timothée and myself. You know, Timothée has been working with me, really developing Bramham Gardens and then Queensfield from almost the beginning. He's completed his PhD and is now a full-time employee at Queensfield, where he's very active and especially has been instrumental on developing EquityEdge. On my side, I left Deutsche Bank in 2014, and in fact, since then I've been more or less an entrepreneur, developing first Bramham Gardens, trying to understand the risks in a different manner, and then launching Queensfield, and within Queensfield EquityEdge. Before, I have been the global CIO for wealth management at Deutsche and the head of multi-asset at DWS, which is a sister company of Deutsche Bank. Good. With this, I think that maybe let me talk about how it's going to work. I'm going to give some introduction on how EquityEdge works. We then are going to have Timothée really presenting the tool and how it works. And then Philippe and Laurent are going to come with expressing some views. Please feel free to use the chat. We will actively monitor the chat, especially at the end of these 4 steps. And in the end, we'll have really completely some open conversation. And several people have asked me to record all of this so that they've not been able to attend, but they were interested in getting some memories of what happened here. I've recorded, or we're recording this so that it's completely transparent. Okay, so with this, I think we are ready to go into EquityEdge. Let me start from the beginning. In fact, we started EquityEdge, which is a tool meant to deliver data and information on risk, because in fact Queensfield is first of all is aiming to be an asset manager running money, but one of the things that is important is that in the domain of AI and things like that, artificial intelligence, there is a risk that things are a bit opaque. And the first thing we wanted to do is to be as transparent as we could on the methodologies we used and our mindset. This is the reason why we started to disentangle almost everything we could. And once we did that, we realized that in itself it was a product, and that we could make this effort of transparency into a product, EquityEdge. There we are. And we, in fact, now EquityEdge is something that is going to grow, develop, become even more transparent, have its life, a life of its own. Okay. Now, what is the background related to this? Well, first of all, in the asset management industry in which I belong in for many years, I realized that our measures of risk are essentially backward looking. When you look at volatility, when you look at CVAR, VAR, whatever, it is looking at a distribution of historical returns and characterizing it using statistical measures. What we wanted to do is to have a measure of risk which is more forward-looking. So this is the first idea, moving from a backward-looking measure of risk to forward-looking measures of risk. So in fact, what we did, and that was at the time of Brahman Gardens, is that we developed different measures of risk. We're going to talk about them. These measures of risk have led to two patents. One of these has been, in fact, endorsed by Standard & Poor's to create a family of S&P branded indices. So that means that you know, it is credible. And the idea with these measures of risk is not to predict the future, but it is to understand what is the mindset of investors versus the future. In other words, their sentiment towards the future, trying to capture that, because investment decisions which are being made today are being made by people who think of the future and try to assume or make some assumptions about what is going to happen. And this is what we're trying to capture in order to help people to mitigate risks. So, in fact, this has been our objective. There is a second observation, which is that, in fact, when we talk about the price of an asset, the price of an asset is the combination of what relates to investments, future cash flows, and what relates to investors, which is the discount factor. And in fact, it is when investments meet investors that we come to a price. And although in the community of people, a lot of people are work on investments, there are few working on investors. So our idea here is to say, okay, let's focus on the mindset of investors, on the discount factor, try to understand it more, because it's a critical element to the price of an asset and of an equity asset, which is not completely understood or researched. In fact, one of the things that is striking in this direction is that the variation of the discount factor is in fact the risk appetite or the risk aversion of the investor. And it's purely mathematically the normalized change of discount factor is in fact the risk appetite of the investor. So talking about the discount factor or talking about the risk appetite of investors is almost talking about the same thing, which is a good thing. So you can see we were looking at forward-looking measures of risk. We secondly considered that in the price we're interested in the mindset, the sentiment of investor leading to the discount factor. This is the same reality. We have something that is clear. Now, the difficulty with these things is that most of people who work with topics make them complex. What we wanted to do was to have something that is super simple, so that in the end, the signals we produce are, in fact, either we're in a risk-on mode, we're in a risk-off mode, or we're in a rebound mode. So 3 signals. Risk-on means it's a steady development, low volatility, reasonable returns, and you know, a 2017 type of environment, okay, where everything is blue sky. Then there are market conditions which are more choppy. In fact, 2020 is one of them, because it has been choppy on the way down and choppy on the way up. And so this is the reason why we distinguish between risk off and rebound. Risk off is on the way down. Rebound is an environment that is not completely stable. It is high volatility, but it is on the way up. And actually, this is a very important point in the sense that that normally people who are doing things using quant things are not very good at capturing the rebounds. Now, in fact, in order to come with these three signals that are very simple, we have underpinning methodologies that are quite diverse. So let me rephrase things. We started willing to go for forward-looking measures of risk. We understood that forward-looking measures of risk and the discount factor is the same thing. He's talking about the same thing. We need to talk about that in a simple manner with some simple indicators. Underneath these indicators, there is some refinement. Typically, people who've been trying to address this sector, been trying to look at trends in the market, moving averages and things like that. In fact, we're not particularly interested in that. We go way beyond that. So what we're doing is, in fact, we're using four approaches, four intuitions. Intuition number one, people who go to the option markets express views on the future outcome of the market. There are around 15,000 contracts on the S&P 500 on a daily basis. That means that there are 15,000 people or groups of people willing to take position at different strikes at different maturities. This means that, in fact, there is a variety of appetite for risk which is being expressed. This variety is, in fact, very interesting to follow because there can be either a consensus or a high level of dissent. It varies from one day to the next. So we're able to capture not directly volatility, not the VIX, to capture the risk appetite of investors and the diversity, the degree of consensus of these investors, something quite unique, which led to a first patent. Second patent is the fact that when we look at the price of an asset, the price of an asset is in fact like a concert. In a concert, in a symphony, there are different players, different performers, and each of them plays a different song to bring to a complex signal. In fact, the price of the market is the combination of different buyers and sellers. Using artificial intelligence, in fact, people are able to disentangle what relates to one type of instrument and another type of instrument. We're not able to do the same with one buyer, one seller, but we can distinguish buyers and sellers by their investment horizon. And in fact, we can distinguish people in the market, investors, at different investment horizon and measure their level of stress. This means that by removing or being less, emphasizing less the short-term investors, we're getting a feeling for what is the mood in the market, what is the sentiment at different horizons of time. And this is forward-looking, very instrumental. We call this turbulence. And in fact, we're able to measure the degree of turbulence on a regular basis in the market, from a forward-looking perspective. So this is the second pattern we have. The third approach that we have to risk is that we notice that different investors with different horizons tend to have different views. And when the views of investors tend to diverge or converge, this gives a signal about whether the market is likely to rebound or not. This is the third one. The fourth approach that we have is taking the example of a horse race. In a horse race, in fact, prices are not the price dedicated to a horse or another. It is the odds. It is what is the likelihood that this horse is going to outperform the next one. And in fact, when the price changes on an asset, or when somebody decides to invest into Nestlé rather than Parmalat, he's betting on one versus the other. So what we're trying to do is to get the relative view coming from the price on the preference on one asset versus the other. So this is the fourth aspect that we are leveraging in order to understand what preferences of investors are in the market. From that and gathering all of that, we're able to form these simple views, whether we're rather in a risk-on mode, risk-off mode, or rebound, on geographies, on sectors, or on single stock. Okay, from this, what I suggest is that I hand over, I've talked too much already, is I hand over to Timothée, who will show you the way all of this works, and he'll be sharing his screen in this respect. Over to you, Timothée.
Okay, thank you, Arnaud. Okay. Yes, okay.
You need to be a bit louder, Timothée.
Okay. Do you see my screen? Yes? Okay, perfect. Okay, so this is, once you're logged in, this is the EquityEdge website. So albeit our signals tend to be quite sophisticated, we try to keep the presentation as simple as possible. And for now, we are going to focus on the center part of the page, which is the risk appetite monitor. So actually, what we do is that we are able to produce a very simple signal, as Arnaud said, which is that either one sector, either in the US or in Europe, or in the next couple of weeks, even a single stock, is either on the risk off mode, so high volatility associated most of the time with negative returns, a rebound mode, which is something a mode with quite a lot of volatility, but tends to be an upward volatility, or a risk on mode, which is something with a steady positive return. So here, for example, we see that we have our 10 gigs sectors for the two geographies, and we have quite a nice environment, because in Europe, for example, most of our sectors are in a risk on mode. In the US, most of them are in rebound mode, so in blue, except for energy, which is in risk of mode, either in US or in Europe. So for example, if I click on one particular sector, I obtain this kind of page. So what I did is that I did a screenshot of this page for the energy sector in the US at the beginning of February 2021, just to illustrate the COVID-19 crisis. So the presentation is actually quite simple. What we see is that on this side of the chart in gray, what we have is simply the evolution of the price of the sector over time. So this is a sector for now, but it could be also a single stock in the next couple of weeks. And obviously, we see the huge drawdown in March 2020. And in green, what we have is the evolution of the risk appetite monitor signal over time. So this is only for the 12 past months, but all of our data goes back until 2006. So basically what we see here, for example, is that we perfectly fitted the beginning of the crisis, because we were in the risk off mode, so we were off the market. But despite that, we were able to capture some of the rebound because we re-entered the market as soon as April 2020. Then we also perfectly fitted the next drawdown during the year, and come back in the market as soon as November to capture some of the rebound at the end of the year. So the performance of the signal can be summed up on the lower sidebar of the page. So here we see, for example, that for the risk of modes over the past year, we tend to have a quite negative Sharpe ratio, whereas for the rebound mode, we have a high positive Sharpe ratio. And we can have the same time of performance on a longer time frame, so from 2006. And we see that, for example, for this sector, we have perfectly classified the different market conditions, as the Sharpe in the risk on mode is way better than the one in the rebound mode, and the Sharpe of the risk off mode is even negative. So this is for the assessment of the quality of the signal, which can also be summed up in the reliability score that you can find just right here. And if I go back to my page here, for example, so let's go back to the energy sector in the US. You have the, let's say, prospective value of the appetite monitor that can be used on a daily basis. So every day around 1:30 p.m. London time, our signals are updated. And they deal with the next trading day. So for example, here for the energy sector in the US, we are still in a risk off mode for the next trading day. And we can see that our signal tend to be extremely smooth over time with the probability of occurrence. So the way to read it is extremely simple. What we simply say is that, okay, today we are in a risk off mode. So we have a 95% chance to stay in the risk off mode tomorrow, which means that if our signals are used as a tool for your asset allocation, you won't have to modify your asset allocation one day from another, most of the time. And we obtain the risk of mode thanks to the three signals that Arnaud already described a little bit, which are also extremely simple to read. So the first one is patented and is called risk casting. As Arnaud said, investors pay to express some views in the option markets. And all of their views tend to incorporate all of their biases. And what I mean by biases is all of their aversion toward risk or risk appetite. And this is something that is definitely not constant over time. So this is an information which is quite difficult to retrieve because, as Arnaud said, we have a lot of different contracts that are exchanged every day. But this is something that that have a real predictive value. And thanks to our AI tool, we are able to extract and that we display here in a very simple manner, which is that we use the rating scale. And risk casting can have 3 different ratings, which are AAA, obviously the best one, low volatility, positive returns, BBB, the neutral one, and G, which is the worst one that we tend to avoid, with high volatility and negative return. The second patented signal is called low turbulence. So as Arnaud said, low turbulence is actually quite powerful and simply looks at the market as they are, confrontation and a combination of different agents, different investors with different time frames. And actually what we are able to do is to disentangle all of these different type of investors with different time frames. And we can have some insight about the level of stress in the market, especially for medium to long-term investors. And we can classify 2 very simple type of periods, high turbulence, low turbulence. Obviously, we try to avoid the high turbulence periods associated with the high volatility, negative returns, and tend to focus more on the low turbulence periods with low volatility and positive returns. Those signals are quite useful, but they tend to focus on the level of stress in the market, and we needed another signal to introduce some kind of temporality and to focus a little bit more on the dynamics of this kind of risk aversion. As Arnaud noticed, there is something quite interesting with most of quant models. Actually, what they do is that for most of them, it is a sophisticated way to forecast the volatility. And this is actually quite normal because targeting the next day volatility is maybe one of the less complicated challenge in finance because financial time series tend to display some kind of volatility clusters. But as we have seen in 2020, forecasting the volatility is not enough. What I mean, for example, if I take back the energy sector in the US in 2020, we saw that if you correctly targeted the volatility, obviously you avoided the huge drawdown at the beginning of the year, which is quite nice and interesting. But most of the time, you wouldn't have entered again in the market for quite a lot of months. And you will have missed, for example, an opportunity to go from something like 45 to 75, which is something like 66% rise. So targeting the volatility is definitely not enough. And we have to somehow separate the different type of volatilities, the downward one and the upward one. This is why we use what we call the rebound signal, which is also extremely simple to read. Either it is yes, it is activated, or no, it's not. And the combination of the 3 produce our risk appetite monitor. Very simple to read, risk off, rebound, or risk on. And this is how we obtain this classification for all of our sectors every day. And as I said, we tend to be quite bullish right now in Europe and even in the US, except for the energy sector. And we can think about an asset manager that can use this kind of information, either, for example, to decide to go on a specific sector, but even in terms of asset allocation at the index level. So what we did is something extremely simple, which is that for Europe, for example, we said, okay, let's take a look at the 2020 period, and let's construct a benchmark. Very simple. We take the 10 sectors and we invest in them with an equal weight methodology. And two strategies. The first one, simply saying, okay, I'm going to simply avoid the risk of sectors every day. And a second one, just investing only in risk of sectors. And what we obtain is something like that, which is quite interesting, because in blue we have our benchmark, which is negative year to date in 2020. In gray we have our strategy only investing in the risk of sectors, and in orange the strategy only investing in sectors that are not in a risk of mode. And what we see is that first, we perfectly fitted the COVID-19 drawdown, but we got back in the market as soon as April. And thanks to that, we were able to take some of the rebound while only suffering a 4% drawdown. And for example, just using this very simple strategy with quite few change in terms of allocation over time, we were able to produce a 20% overperformance over the benchmark. So this is for the risk appetite monitor. As I said, for now, we have it for the sectors in US and Europe. And in the next couple of weeks, we will be able to do exactly the same thing for single stocks. And what we can do also is think about a way to use our asset allocation, this time at the geographical level. And to do so, we have another tool, which is called George, for guidance and early observation of risk in the global economy. And if I click, for example, here on United States, you will find the same kind of data as in the risk appetite monitor. So the degree of market turbulence, the probability of rebound, and a rating about the investor sentiment. And the combination of all of them can give us a standard allocation directly on the geographical level. So for example, here in the US, if we consider only four simple, very traditional assets, the S&P 500, the NASDAQ, the 10 years treasuries, and gold, we are able to produce an asset allocation for different type of investor. First type, which is smooth ride, just avoiding all of the drawdowns and grinding low positive returns over time, or opportunistic, which tend to focus a little bit more on gaining from the rebounds. We can have a possible asset allocation every day between the four different assets, for example. So we see here that when we are in a relaxed mode, we tend to have a little bit more of equity, as much as 90%, whereas in the cautious mode, we tend to be quite loaded in treasuries and gold. And thanks to that, we are able to produce two strategies with very steady returns that you can see in green, and tend to quite largely outperform our two benchmark, whereas the S&P 500 in total return or the 10 years treasuries. And we can also see that taking into account the rebounds in 2020 was quite interesting and important. Yes. I think it's all for me, Arnaud.
Yes, thank you, Timothée. I think that it shows one thing, which is that at a time when fixed income is not an easy source of revenues, looking at using equities with a risk mind becomes quite important. Now, before we finish with that, I'd like to go to Laurent now and ask Laurent a very simple question. Laurent has traveled the world to in particular, but not only, discussed with many asset owners. What is your perspective, Laurent, of the interest of such an approach to these asset owners, or what would they consider about it?
Yes, thank you, Arnaud. Look, I think my experience is that large institutional investors, even the ones actually who outsource mostly their assets, the management of their assets, they are more and more keen to get research-driven insights on risk and performance drivers, because they need to understand better and to communicate better and more on the risk factors they are exposed to. It's part of their fiduciary duty. It also helps them, obviously, to design their strategic asset allocation. And more, what we have seen is that it gives them a reason for a better dialogue with asset managers. It gives them a kind of a common language that they can share to talk about performances of the asset managers they outsource to. So in this respect, I really believe that EquityEdge can be very useful to asset owners globally. And one very important aspect that you and Timothée have highlighted, and that I really like in the product, is that it is easy to read and therefore easy to use and to implement. It's very important to me because one problem that I have seen asset owners have more and more is that they get tons of data, tons of analyses from many different providers in many fields, and very often they actually struggle to aggregate all of them and come to a simple, practical, actionable view. And what I really like is that I believe EquityEdge bring that type of view.
And Laurent, if I come here, the fact that it is related to behavioral aspect is something that is okay to them?
Yes, again, my interaction with them has been that they are keen to get new data. Sometimes we speak about alternative data, because as I said, they are loaded with tons of data, but in fact, what they are keen to get is new angles on the financial markets, something that does not overlap with what they already have, obviously. I believe this is why factors, for example, are very in demand or very interesting, because obviously they bring a different view than the traditional ones like sectors or geographies. I also believe this is why ESG is highly in demand, because ESG is nothing more than, in fact, an angle, an alternative way to assess risk of drawdowns for companies which would not comply with ESG requirements or ESG standards. So in this environment, I think that the focus that you have described of EquityEdge, in particular on the investor sentiment, is something new. So in this respect, I believe that it should have a lot of appeal for asset owners. And more specifically, to coming to the AI aspect of it, I think that we have been talking a lot about AI in the asset management industry in the last few years, but we haven't seen a lot of actually ways to use it, to implement it in the investment process, except for purely quant funds. And I really like the idea that EquityEdge, again, is a way to make alternative investment data and research accessible across the board to any kind of portfolios and to any kind of managers.
Thank you.
And Laurent, before joining MSCI, you also worked for Seyer, which we all know as one of the leaders in passive investing. How would you imagine EquityEdge could bring some value to passive investing?
Thank you, Timothée. Look, I think what is fascinating with passive investing is that it has been growing a lot for decades now. And in fact, it is still only 40% of total global equity assets managed around the world, 40%. So I believe there is still a huge potential for growth for passive equity investing. And the way it grows and the reasons why it grows, first of all, there is a switch clearly, sometimes from active to passive. But more importantly, I believe there is an evolution, and we have seen that a lot at MSCI, of what is passive investing. An evolution from traditional market cap indices that basically simply measure an opportunity set, a universe, potential, to new types of indices, like thematic indices, like customized indices, to represent not a universe, but an investment thesis. And this is a new way to obviously use indices. And there are many, many ways to implement such views. We often obviously think of ETFs, but there are also other vehicles like separate managed accounts that are very popular in the US, and in the retail space, retail structured product, or even direct indexing that are more and more initiated by a wealth manager. So again, I think that EquityEdge is an incredibly powerful tool and basis to basically design such new types of indices that will implement AI-driven strategies in the index wrapper. So that's my view.
Thank you very much, Laurent. If I may, because I see that the time is running, getting to Philippe. Philippe, you've been the CEO of a large firm, but you are an active manager at heart, and you've started your career in that. When you see EquityEdge with the mindset of an active manager, what do you think? What is your mind?
Well, thank you, Arnaud, and good afternoon, everybody. So I would say that from a portfolio manager perspective, the toughest decisions are twofold. First, when you are an asset allocator, like I was managing diversified portfolio, the question is, when do I enter the market? How much do I allocate to the equities? Do I overweight equities or not? When do I get out, etc., etc.? That are very tough decisions. And so the portfolio manager, if he gets some help and some decision tool that can help him making a decision, it's very powerful. And so look just at 2020. 2020 is a very interesting year because it has been a stellar performance for stock markets. And you have a lot of portfolio managers that have exited the stock market in March, April, etc. And so the problem was, and the question was, when do they reinvest, when they do re-enter the market? And a lot of them did not, because it was a very tough decision. As a stock picker, well, you have some, would say, emotional biases. You love the stocks you bought. So sometimes it's very much difficult to sell a stock when you lose money on it. That the most classical thing I've seen, having been a portfolio manager or having seen the portfolio managers and some stock pickers doing. So that's why, for example, if you look at RFPs from asset owners, they are always, or consultants, they are always asking about selling discipline, because there is an issue there, which are such emotional biases. So if you have some help to strengthen your opinion, your analysis, your decision-making process, so it's an help. And in that respect, EquityEdge is absolutely key and absolutely instrumental. So it can help both the passive side of the asset management world and also the active side for sure. So there is another bias that I've seen, of course, which is just the human brain. You cannot know by heart the full universe that you have at your disposal to invest. So the biases you can see there is that you have the stocks so in a good sense or bad sense, that no matter after all, but there are stocks then there are stocks you don't know, then there are stocks you less know, etc. So making a decision there is, of course, sometimes very much difficult. And so you need, of course, fundamental analysis, technical analysis, every kind of analysis you need is welcome, would say. And in that respect too, I think that EquityEdge, when you look at the help it brings for countries, for sectors, for style, I hope, and stocks, that can help, because you have also to decide on style. You've seen that, for example, since last year, the value style is very much, I would say, performing in the market. So how do you decide to allocate there, et cetera, et cetera, et cetera. So I think that there are a lot of things that make this tool very much instrumental for an active asset manager.
Thank you. Thank you. Any question? Maybe I'll ask, you know, the fact that it is AI, artificial intelligence, if you're an active manager, you're not scared about this?
On my side, I'm not, because I think it's a clear plus. It helps. It helps a portfolio manager building or making his decisions. That's very much important. If you look at the artificial intelligence, for example, in the medical sector, so particularly scans and brain scans, particularly, that's very much interesting. What does it does? It helps radiologists to interpret faster. Second, to identify some specific pathologies they are not familiar with, because, well, the scan has learned and knows all these issues. It limits the risks of incorrect diagnosis, and at the end, it increases their efficiency. So they gain time, they gain efficiency, and they can focus on very tough matters, very difficult matters. So for me, that's exactly the same for a portfolio manager. It helps him. It allows him to focus on what makes a difference ultimately for a portfolio manager, I think, which is the well, human experience, human knowledge, and intelligence, human intelligence there. So that's perfectly complementary.
Okay, okay. Listen, I think this has been very insightful, all of this. I don't know before if there are in the virtual room some people who would be willing to ask us some questions, either to the two guests or to myself or Timothée. Please feel free to do so if you're in this booth.
Hello, Arnaud. This is Fred Sage. Can you hear me?
Yes, Fred.
So, Arnaud, you're obviously familiar with our focus on the application of artificial intelligence to the investment management industry and the universe of AI-powered funds and so forth. So, with regards to EquityEdge, how would a, let's just say, traditional discretionary portfolio manager, how would they go about integrating EquityEdge just as a tool in their core investment process?
Okay, Fred, I can talk about a practical example I have in mind. In fact, some portfolio managers who are very fundamental, they tell you generally that they look at firms and they buy the firms they like. And they do not really focus on the sector, the style, and things like that. So there is one first element, which is that you may like a firm very much. And if it is in a sector that is suffering, it's good to know, because overweighting or underweighting this firm, depending on the level, the degree of health of the sector, is very important. So that is a simple way to overlay an element of judgment at a sector level for these people who are just picking on a stock-by-stock basis. I would say that in a multi-asset space, we've had our first client for EquityEdge last week, who is a wealth management a private bank. And what these people want is to have something that unsettles them a little bit, because in fact, in their asset allocation or in the allocation of among various asset classes, they tend to be very steady. And when you have got a cliff moving from risk on to risk off or rebound, this is something that in fact has an impact on them to say, okay, should we be doing something in terms of scaling down risk or not? So this is the second element. The third element is that people like Philippe was saying, when in a given sector, there are some firms that somebody is very familiar with, loves, almost saying, okay, my Saint-Gobain in Europe is the firm I really like. But in fact, having a look at how peers are doing, whether it is relevant to choose Saint-Gobain or whether it is relevant to use another firm, is something that opens up the opportunities, which is not something that is done easily by people, because it creates an effort to push in order to research another firm we're not very familiar with. So these are the three practical applications I've seen recently. I don't know whether I answered your question, Fred, but it gives some ideas.
You have. Thank you, Arnaud.
Any other question? Okay. Well, listen, this has been, I thank you very much for your participation. Because we've recorded all of this, we will make this available online so that you can review it and share it with some of the other people who you think might be interested in it. Thank you very much for this. Have a good day. And very happy to follow up with you on EquityEdge if you've got more demands or remarks, observation on, you know, you can do that privately coming back to me or to us. Thank you very much.